Now, the capital asset pricing model allows us to calculate an expected return on a stock based upon its amount of systematic risk. The CAPM equation is going to produce us with a risk premium for a stock that is a function of its systematic risk, and that risk premium gets added onto the risk-free rate. As you remember from Chapter 12, a risk premium is any return in excess of the risk-free rate. So when we compute a risk premium for a stock, then that would be added onto the risk-free rate to produce an expected return for that particular stock, which is based upon its amount of systematic risk. The CAPM equation looks like this. It says the return for a particular stock I would start with the risk-free rate, just like any return starts with the risk-free rate, and then something would be added onto the risk-free rate. By definition, anything added on to the risk-free rate is a risk premium. And this whole last portion to the right of the plus sign is the risk premium for stock I. Stock I is the stock whose return we're trying to measure or forecast using the capital asset pricing model. So the risk premium for stock I is everything to the right of the plus sign. It is stock I's beta times this term in parentheses. By definition, this term in parentheses is called the market risk premium. A risk premium is anything in excess of the risk-free rate. So when we take the market return minus the risk-free rate, that is the market risk premium. It's the market's return in excess of the risk-free rate. We take that market risk premium and multiply it by the beta of stock I to produce stock I's risk premium, and that's what gets added onto the risk-free rate to produce that expected or required return for stock I. Now again, what's in parentheses here is called the market risk premium. When it gets multiplied by beta, the beta of stock I, that is stock I's risk premium, and that's what gets added onto the risk-free rate. When thinking about the risk premium for stock I, it's important to note when we take that beta of stock I and multiply it by the market risk premium, the beta of stock I is telling us how many times the market risk premium gets added on to the risk-free rate as stock I's risk premium. The beta tells us how many times to multiply the market risk premium to produce the risk premium for stock I, which gets added onto the risk-free rate. So, example, PDQ has a beta of 1.5. The risk-free rate is 6%. The market's expected return is 12%. And we want to compute the required return per the capital asset pricing model on PDQ stock. So the market return is 12. The risk-free rate is 6%. So our market return of 12 minus our risk-free rate of 6 gives us a market risk premium of 6%. That's multiplied by the beta of stock I, which is 1.5. That product of 9% gets added on to the risk-free rate of 6% to produce the 15% required return on PDQ stock. We need to remember our order of operations here to do what is in parentheses first, to calculate the market risk premium of 6%, multiply that by the beta of stock I, which is 1.5 times. The market deserves a risk premium of 6%. PDQ deserves 1.5 times that for its risk premium. So PDQ's risk premium is 9%, which gets added on to the 6% risk-free rate. So we would require a 15% return on PDQ stock to fairly reward us for its beta of 1.5. The security market line is simply a graph of the CAPM equation. So if we have a Treasury bill rate of 6% and an expected return on the market of 12%, we can establish the security market line if we just simply have 2 points on that line. The 2 easiest points to use in drawing the graph of the security market line are the points where there's a beta of 0, which corresponds to the risk-free rate, and the point that has a beta of 1, which corresponds to the market return. Remember, the T-bill has a beta of 0, and it produces the risk-free rate, and the market has a beta of 1, and it produces the market return. So that gives us 2 points with which to create our security market line. The beta of 0 along with the risk-free rate produces this point here, beta of 0, the risk-free rate. The beta of 1 produces the market return, and the security market line is the graph going through those 2 points. Notice that the slope of the security market line will be the market risk premium, because 2 points on the line correspond to the beta of the market and the market return, and the beta of the T-bill and the risk-free rate. The rise, the vertical change of that line will thus, between those 2 points, will be the market return minus the risk-free rate. That is, by definition, the market risk premium. The horizontal change between those 2 points must be 1, because those 2 points correspond to a beta of 1 and a beta of 0. So that horizontal change will be 1. The vertical change will be the market risk premium. Thus, the market risk premium is the slope of the line, which in this case is 6%. Notice our independent variable for the security market line is beta. Beta tells us how many times that market risk premium gets added on to the risk-free rate to reward us for bearing the systematic risk of a particular investment. So if a stock has a beta of 2, we'll add on 2 times the market risk premium, 1 time to add on a risk premium moving from a beta of 0 to a beta of 1, increases the return 6% above the risk-free rate. Adding on another beta of 1, getting up to a beta of 2, means we would add on the risk premium of the market a second time, another 6%. So for an asset with a beta of 2, we would expect a return of 18%. We start at the risk-free rate of 6%. We add on a risk premium of 6% per unit of beta. If we do that twice, we've added on 6% to the risk-free rate 2 times for an asset with a beta of 2. Now let's use CAPM to calculate the required return for 2 securities, stock A with a beta of 0.5 and stock B with a beta of 2. And we'll plot them on the security market line that we just generated. Plugging those into CAPM, the beta of 0.5 is multiplied by the market risk premium of 6%. That produces a risk premium of 3% added on to the risk-free rate of 6, producing a return of 9% for stock A that had a beta of 0.5. For stock B that has a beta of 2, then we plug in the beta of 2 here and multiply that by the market risk premium, and we'll see that the risk premium is 2 times the 6% market risk premium, or 12%, added on to the risk-free rate of 6%, giving us our required return of 18% for stock B that has a beta of 2. Now, think about what you would do if you actually analyze stock A that has the beta of 0.5 and you predict it would actually return 12%. CAPM indicated we should require a 9% return to be fairly rewarded for that stock's systematic risk equal to its beta of 0.5. So we should require a return of 9%. But we analyze the stock and we predict it will actually return 12%. That's the type of asset we want to buy because we expect it will actually return more than we require. We expect 12%, we require 9% per CAPM. That exceeds our required return and we should want to buy that stock. CAPM tells us or shows us through the security market line that 9% would be a fair return for an asset with a beta of 0.5. If a stock is actually expected to produce a return above what we require, we want to buy it. It's underpriced. If 9% is a fair return, 12% is more than fair. It's the type of asset we want to buy. As we and other investors start to expect a 12% return on something for which 9% is fair, a lot of investors will go to buy that stock to get the higher return. As they do that, they'll bid the price up, forcing the return to drop. Prices and yields move inversely. So as the price gets bid up, the return will get pushed down until the stock is expected to fairly provide a 9% return, which is a fair return for its beta of 0.5. So anything along the security market line is fairly priced. We expect it to produce a return that is a fair reward for the stock's amount of systematic risk. Anything above the security market line, we expect to produce a return that is more than we require. That's a good investment. It's underpriced, and it'll continue to be underpriced until the price gets bid up far enough to cause its return to fall, and it sets right on the security market line. If a security is below the security market line, it is overpriced. Its return, measured on the vertical axis, would be too low to fairly reward an investor for its systematic risk. So if we expect something down here and we require something per the security market line that's higher than that, we don't want to buy the asset. So its price will get pushed down, its return will get pushed up until it lies on the security market line where its expected return equals its required return, and we expect it to fairly reward us for its amount of systematic risk as measured by its beta. So theoretically, every security should lie on the security market line where investors are being fairly rewarded for systematic risk as measured by the stock's beta. If not, something is mispriced. So if you think that a security's return is too high for its risk, its price is too low. Prices and returns, prices and yields move inversely, everything else equal. So you'll buy a stock if you expect its return is higher than what you think it should be to fairly reward you for its risk. So again, since we have returns on this axis, things above the line are over-returning, we say they're underpriced. Anything below the line is not producing enough return, so they are overpriced. So some comments about beta and CAPM. The beta of a portfolio is a weighted average of the betas of the assets in the portfolio. We'll see an example of that in a moment. We already saw the beta of the market is 1 and the beta of the T-bill is 0. We know the beta measures the systematic risk of a stock and it also measures the systematic risk of a portfolio that we'll see in a moment. Per the CAPM equation, beta tells us how many times the market risk premium is deserved by a stock for its own risk premium. So beta tells us how many times the market risk premium is deserved as the risk premium for a particular stock. Beta and CAPM are relevant for well-diversified portfolios because they assume the company-unique risk, the diversifiable risk, has been gotten rid of and only systematic risk remains. Because the only measure of risk in the capital asset pricing model is systematic risk as measured by beta. There's no other risk in the model, so it's assumed that other risks have been diversified away. Only systematic risk remains. As we've seen before, the risk premium is a reward for bearing risk and is anything in excess of the risk-free rate. So CAPM shows us that systematic risk deserves a risk premium while unsystematic risk does not. Systematic risk as measured by beta is the only risk reflected in the capital asset pricing model, so it's the only risk that deserves a risk premium. Why is that so? Because if someone bears unsystematic risk, they have simply failed to diversify. And the market is not going to reward an investor for failing to diversify. They will not be rewarded for unnecessarily bearing unsystematic risk because it can be diversified away. Now let's talk about the beta of a portfolio. We don't need to create a characteristic line for a portfolio to measure its beta. We may not have historical data for a particular portfolio in order to estimate beta, but we can estimate the betas of the individual stocks in the portfolio and take their weighted average to calculate the beta of the portfolio. We'll start with what's called a portfolio weight. The portfolio weight is the percentage of the portfolio that is held in each stock. In example 13.5, we own two stocks. Stock Q, of which we own 1,000 shares with a price of $28 per share, and stock Z, of which we own 2,000 shares at a per share price of $44. We're supposed to calculate the portfolio weight of each stock, and then we'll want to verify that those weights add up to 100% so we can see that we've accounted for all the value of our portfolio. With 1,000 shares in stock Q at a price of $28 each, we have $28,000 in stock Q. With 2,000 shares in stock Z with a price of $44 per share, we have $88,000 in stock Z for a total portfolio value of $116,000. Percentage-wise, we calculate the weight of Q by taking the 28,000 in Q divided by the 116,000 total, and we see that 24.14% of our portfolio is invested in stock Q. That's the weight attached to stock Q. With 88,000 invested in stock Z, that accounts for 75.86% of our portfolio value in stock Z. Combined, they account for 100% of the value of our portfolio. Now, let's calculate a portfolio beta and use that to calculate the required return on a portfolio. Stock A has a beta of, stock ABC has a beta of 0.9. Stock XYZ has a beta of 1.8. The risk-free rate, or T-bill return, is 6%, and the market return is 14%. We're supposed to calculate the expected return of each of those stocks, as well as the portfolio, if we put 40% of our wealth in ABC and the rest of it, the other 60%, in stock XYZ. We're told to first calculate the portfolio return by weighting the betas to calculate the portfolio beta. In other words, we'll attach the 40% weight onto the beta of ABC, and we'll attach the 60% weight on the beta of stock XYZ to calculate our portfolio beta. So with 40% of our wealth invested in ABC with a beta 0.9, and the other 60% invested in stock XYZ with a beta of 1.8, our portfolio beta is 1.44. We can calculate the required return on our portfolio now by plugging our portfolio beta into CAPM. The 1.44 portfolio beta is multiplied by the market risk premium of 8%. So our portfolio deserves 1.44 times as much risk premium as the market as its own risk premium added on to the 6% risk-free rate. So we expect our portfolio to return 17.52%. That would fairly reward us for our portfolio's systematic risk equal to its beta of 1.44. We're then told to calculate the expected return of each asset and take a weighted average of those returns. If we plug the betas of stock ABC, which is 0.9, and stock XYZ, which is 1.8, that gives us the risk premiums for stock ABC and stock XYZ to add on to the 6% risk-free rate. Thus, 13.2% would fairly reward us for stock ABC's beta of 0.9, and 20.4% would fairly reward us for stock XYZ's beta of 1.8. Our portfolio has 40% of our investment in ABC, and that's expected to produce a return of 13.2%. And the remaining 60% that we saw in XYZ, we expect to return 20.4%. So our portfolio return is the weighted average of the returns of those two stocks. Thus, we expect the portfolio to produce a return of 17.52%. We got that by taking a weighted average of the expected returns of the two stocks. It produced exactly the same result as when we took a weighted average of the betas and plugged that portfolio beta into CAPM. It's algebraically equivalent if we take the weighted average of the required returns of the two stocks, or if we take a weighted average of their betas and plug that beta into CAPM. We'll get the same required return for our portfolio either way. Now, stock XYZ has a beta of 1.8 that is twice the beta of stock ABC, which was 0.9. But stock XYZ is not expected to produce twice as much return. Stock XYZ is expected to produce a return of 20.4%, whereas stock ABC is expected to produce a return of 13.2%. We don't expect twice as much return from XYZ. We do expect twice as much risk premium. In other words, when we double the beta, we double the risk premium, but we don't double the total return, because the risk-free rate is not doubled when the beta is twice as high. Only the risk premium portion is doubled, because the risk-free rate is not multiplied by beta. Only the risk premium, the market risk premium, is multiplied by the beta. So chapter 13 can basically be summarized in an explanation of the risk-return trade-off. The risk-return trade-off says that investors will not take on additional systematic risk without additional expected return. Beta measures systematic risk, which is the only risk rewarded by the market. There's no reward for bearing unsystematic risk because it can be diversified away. If this risk-return trade-off did not hold, then we would see people not being fairly rewarded for some risks and being unnecessarily rewarded for other things. So basically, if we take on additional systematic risk, the market entitles us to additional return as a reward for bearing that systematic risk. So if we want additional return, we have to be willing to take on additional systematic risk. For Chapter 13, concept reviews, I encourage you to pause the lecture, read through and fill those out, and then play the lecture and see if your thinking on those items is consistent with mine. The expected rate of return on an individual investment equals a probability weighted average of the possible returns. Each possible return we've allowed for gets multiplied by its associated probability, and we call that a probability weighted average. The measure of the total risk of an individual investment can be measured by calculating the variance, or the square root of the variance is called the standard deviation. It measures total risk because it just considers everything that's different from the mean, regardless of whether it's a systematic or an unsystematic reason. So anything different from the mean adds into that variance and the standard deviation. The variance is a probability weighted average of the squared deviations of each outcome from the mean or the expected return. We compare each possible outcome from the mean, square those differences, and then weight them by their probability of occurring, and that is the variance. That total risk of an investment can be decomposed into the systematic and the unsystematic parts. Systematic being system-wide or market risk factors, things that affect all stocks to some degree, and the unsystematic part being those that affect just one stock or a very small number of stocks. Together, we've accounted for all the risk factors or the total risk of a security. Diversification allows a portfolio to have less risk than the assets that are placed in the portfolio because the unsystematic part of the risk of those assets can be offset by one another. We diversify away the unsystematic part of the asset's risks when we diversify or set up a well-diversified portfolio. A further benefit from diversification is not likely once we have about 30 assets in the portfolio because most of the unsystematic risk factors have been accounted for by the time we choose 30 unrelated stocks at random. Then you can't really further diversify away risk beyond that point. The capital asset pricing model is used to calculate an asset's or a portfolio's required rate of return, using the beta as a measure of systematic risk to determine how much risk premium we add for an asset or portfolio based on its amount of systematic risk. So CAPM assumes a well-diversified portfolio, so only the systematic risk portion measured by beta is relevant. And when we graph that capital asset pricing model equation, we have what we call the security market line, the graph of required return on the vertical axis versus the beta or the systematic risk on the horizontal axis. Beta is estimated by graphing an asset's returns against the market's return, and that market is represented by the S&P 500 or some other market index. That graph is called the characteristic line of the particular asset, and the beta is measured by the slope of that graph. We saw some characteristic lines for the market itself, the T-bill or the risk-free asset, and then a stock with a beta greater than 1 and a stock with a beta less than 1. In each case, we were graphing the asset on the vertical and the market or the S&P 500 return on the horizontal axis, and the slope of the line was our estimate of the beta for the particular investment that appeared on that vertical axis. The graph of the CAPM equation is the security market line, and the magnitude of the slope of that security market line is the market risk premium. The risk-return trade-off says that riskier investments must provide a higher expected rate of return. If they did not, no one would buy the riskier assets because they wouldn't get any reward, and thus they would be unnecessarily bearing risk. In Chapter 13, we learned a lot more about risk and return. We learned that for well-diversified investors, beta is the appropriate measure of risk because it measures only the risk that still remains after one is well diversified. It comes from those types of characteristics that affect all assets, such as the macroeconomic indicators of inflation and unemployment rates and interest rates and things like that. We learned that the higher beta assets should produce higher rates of return, but they also lose more value when the market turns down. We explored the capital asset pricing model to estimate how much return an asset is expected to provide, and we looked at the measurement of risk through calculation of expected return and variance, which measures the total risk of an asset by itself, and reviewed the normal probabilities to determine how likely it is for an asset to produce a certain return over a given period of time. Now that you've completed the Chapter 13 lecture, you should work the practice problems in the rectangular boxes found throughout the chapter in your course notes. The solutions are found at the end of the chapter in the course notes. Complete the Chapter 13 additional practice problems at the end of the chapter, and the answers are found at the end of the chapter in the course notes. Then complete the supplemental homework practice problems found at the end of the chapter in the course notes. The solutions to those are found on iTunes U, where I use the document camera to work them, or you may check the answers by using the PowerPoint file posted to Blackboard. Attempt the blank Connect assignment on Blackboard and then do the actual online Connect assignment. So you'll want to refer to the syllabus so you know what chapters are covered and the due date for that Connect assignment. Then come to class and we will go over the solutions to that blank Connect assignment. If you want us to look at your actual Connect assignment, you will need to print it off or bring your laptop so that we may see the actual assignment that you took and answer any questions over it. Then begin preparing for the exam early. Compile your exam formula sheet as you go, chapter by chapter. Don't wait until the end, but start to prepare that early. And remember, we post the Connect assignments again after they are due so that you can have unlimited practice for each Connect assignment. It will generate new numbers every time you run the Connect assignment, so you can have unlimited practice after the assignment is due because those assignments are reposted after the due date.